You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is financial consultant and wealth manager Richard Knowles of Knowles & Associates in Vancouver. Welcome to the show, Richard.
Thank you, Jim.
Big day for Greece. Germany says pay up or else. Greece could be out of money if they don't go along with the financial deals they had in place. And if they try to bail out, what happens next? Do other countries default as well?
Well, if you'd asked me this question a few years ago, I might have said in 2008, yeah, it could be a very serious fallout. But every country is standing on its own merits within the EU. And it looks as though Greece is the last of what they called the pigs, actually, Portugal, Ireland, Greece, and Spain. There were the suffering countries during the 2008 financial crisis and post-crisis. So far, Spain, while it's still suffering a lot, has enough GDP and output and control over their economy that they seem to be coming out of that. It's certainly stabilizing. They're able to make their own bond debts. They have not needed to borrow copious amounts of money endlessly from Germany in this case. Well, really, it's the EU source, but Germany is the backing of the central banks that are posting all this money in loans. They're also lending it personally from one country to another, apparently. We also have, all the other countries, Ireland and Portugal, that have found their own stability without having to go deeply into the pockets of the EU, although there has been some saving grace, but these are all natural kind of processes of internal government buying of bonds, etc. For example, the EU central banks would be buying bonds, and if need be, from these smaller countries, just to keep them afloat, making sure they have liquidity, etc. There hasn't been extensive amounts of money extended beyond certain types of aid programs that they already had to make sure that they were going to be back on their feet after a period of time. Now, while those countries are still struggling in many ways for employment, etc., they're on their way out. They've had their tranches of help. They've been able to get more support on their own. However, Greece continues to slide, and one of the deepest parts of Greek problems is actually inherent in the Greek system. And I know this because I have people living in Greece, and they are the biggest critics of the situation. So we have, a lot of corruption and things that have been endemic in many countries. Of course, that happens in every country, it seems. Canada is no avoider of that as well. But in Greece, it has been longer and more endemic, you might say, because they're an older country. And one of the issues with Germany has been to put austerity measures on Greece and the way they do business. So the Germans have been saying, if you want our money, you have to do it our way. You have to shore up your investments. You have to shore up your banks. You have to become more legitimate, quit the kickbacks that are built into your system. Stop with the political favoritism and all the stuff that we don't like, and that's where the Greek situation, they're saying, well, they're changing us. The Greeks were saying, well, you're changing us. We don't want to change. We want to be who we are, and we have a right to be who we are. And the Germans are basically saying, sure you do, but not with our money. And so that's the bottom line. It's a simple way of looking at it, and that's the way the Germans see it. It's very analytical. If they're not going to follow the rules, then you don't have access to our money. You can go somewhere else. You can go to the U.S., whatever. You can, make any side deal you want, but we're out. And that's really what's going to be possibly happening here. And if they don't have the support of the German money, then the EU Central Committee will have to look at letting them go out of the currency. So that's the big threat right now. But would that cascade into other countries? Really, not necessarily. Like, only countries that are deeply related to Greece directly. For example, Cyprus, which is a country unto its own, has very deep financial affiliations through history with Greece. So if Greece were to be let go, Cyprus's position in the EU would be tenuous. But they stand on their own, but it depends on what their financial relations will be. We put them under a lot of hard-pressed pressures as well because they're related to the Greek situation. So that's not necessarily the case, but I'm just saying that's the closest that I can see that there would be. The contagion, we'll say, is held at bay. The virus will be held in that one area, I believe.
The Italian bond market, we've talked about it in the past. How is it doing?
Italian bond market has actually been very robust from what I've been hearing. I'm not a fixed income trader, so I can't comment on everything on that. But right now I've heard no negative news about what's going on in Italy. They've got a robust economy. If you want to buy a castle in Italy right now, it's a really good deal. I was just checking online the other day. So if you're looking for something unique to own and a gift to give your wealthy patron or wife, that is a pretty neat place to go. You can buy a small castle, a two-bedroom castle, for about the price of what you can get an apartment in Vancouver.
Well, let's go castle hunting. That must be a fun thing to do.
It's a lot of fun.
Well, Target is bailing out of Canada. And by the way, people said their start of sell-off sales were disappointing. They thought there would be deep discounts, and there really weren't. Walmart is expanding in Canada. It's going to spend $340 million to complete 29 supercenters. However, they're not going to spend as much as planned. Is that a sign the Canadian economy is not ripe for the picking for retailers?
I think the reality of what's going to be happening this year is starting to set in. We've got a very ironic beginning to the year. We had drop in interest rates, which has spurred forward the real estate market, particularly in big cities like Vancouver and other like Toronto. However, while it's propping up and making house prices really expensive and buoyant, the reality is the reason that they dropped interest rates at the top bank level is because they perceive to be us entering into a very negative economy, a recessionary type of style economy. They're trying to sustain the value of the dollar against the oil and gas pricing situation that's been happening with a significant drop in oil and gas prices. So we've got really the picture from around the globe. There's a lot of slowing down globally. China and other places, our biggest suppliers, other than the U.S., our biggest client, has been slowing down significantly. Now, the U.S. will probably be seeing some form of a slowdown as well. It's been perceived by many pundits. So, I mean, we're talking about resources. We're talking about all sorts of areas. Already they've got an oversupply of oil. So that's a good thing for the U.S. They're a consumer-based country. So the picture for the U.S. is far more buoyant than it is for countries like Canada. But it looks to be, and I'm making a forecast here, and I could be wrong, but it looks to be like a global recession might be happening at the end of this year, a slowdown. Now, I don't mean a total depression type of scenario the way we had in 2008, but I mean there's going to be a global type of slowdown, which I think the markets are going to find corrections to flow into when they have an excuse. You know, mid-March is always the Ides of March. You know what they said. The Romans said it. It's true today. Watch for the Ides of March. And a few of the pundits on the street have been, you know, the multi-billionaires are saying, watch for March 15th, watch for April, and then watch again in October. So keep your eyes open for buying opportunities in different types of sectors. But right now, the big talk on the town is trying to get value out of this drop in oil that we're seeing around the world. And where can we find that? You know, you find companies that are in the oil and gas sector. Well, there's a couple of ideas people are talking about. It's been talked about for quite a bit on the street, you know, getting in early on some of these issues. Buying early before there might be an oil correction, there might be an oil bump up. Today, we've been talking about the oil bump. Is this just a dead cat bounce, or is it a sincere growth or a sustainability of oil? We've been expecting this bump in oil prices. It's, you know, we just had a drop. Usually it hits a bottom, and then we get a bump, and then we find our bottom, so to speak, technically speaking. And we're close to that bottom now. At least this is a sustainable bottom. However, there's been talk about it dropping to as low as $20 a barrel U.S. If it hits 20, it would probably not sustain there. It would be a drop and then a bounce back up. So that would be what we call in the industry an oversell. So if it's oversold down and then it would come back up, that's fine. But we think we're near the stable area around 38 to 40. Will probably be its technical bottom for some time. Now, that's great for consumers, but it's not great for oil and gas. And if you're looking for places to go to invest, there's one resource area that looks very attractive right now, but is it too soon? So a lot of the people on the street are saying, is it too soon? Is there going to be other opportunities? If there's going to be market corrections elsewhere? Is this a slowing economy that we're seeing globally? Are we having a global recession? It's a big call right now. I mean, when you look at the U.S. markets, you look at the Canadian markets, we're holding at high levels. Of course, it's February. It always looks good in January, February. But some of the earnings statements that are going to be coming out after the first quarter will be a lot more disappointing. I can almost guarantee that. It's just There's a lot of things happening. The market's jumbling around. We're going to have the oil and gas providers, reporting. It's just going to simply be a little bit more negative news than we saw at the end of December. Because remember, when you get earnings reports, you're looking backwards in time, right? So you got earnings reports, you're looking backwards. You're not looking current. Now, we're guessing what it is currently. But once it gets reported, the actual news hits the wire. That's when everybody actually emotionally reacts. They know it's going to be bad today, but you don't see them trading with that knowledge. They wait until the news actually hits. This is emotional drama, of the psychology of the investor. And then you see what actually happens. And that's what we're heading into. And I believe the first, after March 15th, the second quarter is going to be a correction in the industry based on that, very basic premise of investor psychology. So with that being said, I may be wrong, but I think everybody should have a little cash set aside for that opportunity. Most managers, large managers of money today, pensions, whatever, are doing just that. And they sit their money in cash and they're taking some profits off the table at these high levels, and looking for opportunities in other areas. And of course, one of those, oil and gas, theoretically even in minerals, resources, and other areas that money could fly to. Even the cannabis stocks, medical cannabis stocks today are starting to get a little bit more activity because of their legal suits going to be ending, hopefully being settled at the end of February. So there's a lot of talk of where we're going rather than where we've been.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with financial consultant and wealth manager Richard Knowles of Knowles & Associates in Vancouver. Air Canada says its profits are not as high as expected because the loonie has fallen so much. Even though they're paying less for energy, they didn't make as much money because often a lot of their business is done in American dollars. Is that a concern? Is that something that was unexpected?
Yeah, it wasn't factored in. When I was hearing about the BCE play, we call it a play when you're looking at a stock and thinking of buying it or looking into a sector, et cetera. That really wasn't brought up. The drop in Canadian dollar with people that I was talking to was an issue, but because they're making more money in international dollars, that actually fares quite well for profits at home. Because if you're making most of your money in the United States, for example, but you denominate your final currency in Canadian dollars, if you continue to make money in the U.S. and you profit and bring it back home, then you actually you're making money on the foreign exchange itself with a drop in Canadian dollar. However, Canadian dollar profits will suffer if they're taken to the U.S. because you don't get as much, so to speak, bang for the buck, literally, going to the U.S. with your lower Canadian dollar. So these are issues that are really balancing out. I think that what's happening is that that's a bit of an overstatement. What you're going to find is that the overall picture of the company will do well. And the reasoning is much of the currency of what they make, much of the profit of what they make, I believe, is still international. And their international fares are only hurting Canadian travelers. But if they can keep charging international travelers with increased tourism, they want to capture that new market of increased tourism. So you realize, of course, as it's happened, we already know this if you've lived in Canada for more than 10 or 15, maybe even 20 years. When the drop in the 1990s occurred, the Canadian dollar, we had nothing but American tourists all over the city. Wherever city you were in, you just seemed to find American tourists as long as you were in a major city in Canada. And the reasoning is that they spend more money here because it's a cheaper vacation and it's an opportunity to see, big, vast areas of nature and enjoy the tourism of Canada. So what happens? We get increased tourist trade coming to Canada, more expenditures. This is great for our economy. And you don't want to go too far down with the loonie, but ultimately that exchange rate works in our favor, especially in trade and other things that we do. So with that being said, Air Canada, while we have travel across the country, won't be really affected because the same relative Canadian dollar fare should stay the same, especially with the savings of their gas prices for their airline fuel. Overall, the company should, if you're looking at all factors, while you can isolate individual factors and say, okay, this one will work negatively, which seems to be what we're doing now, the overall picture of where we're going with a lower Canadian dollar and a lower oil price at the same time is actually favorable overall for international airline companies that are housed out of Canada, like Air Canada. WestJet will be another one likely to be profitable in this scenario. So where you want to bank your money is up to you, but in the end, it looks to be a brighter picture than this one isolated bit of information on the drop in Canadian dollar seems to belie.
Richard, thanks a lot for chatting with us.
It's been a pleasure, Jim. Thank you very much.
My guest has been Richard Knowles of Knowles & Associates in Vancouver. If you have any questions for Richard, you can send them to Richard K, that's the letter K, at customplanfinancial.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube channel Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.